Good day to all. My name is Chloe, a senior research analyst from iFAST. Caterpillar, a global leader in manufacturing and construction equipment, reported impressive third quarter 2023 results, surpassing market expectation and reflecting a robust financial performance. The company reported a remarkable 12.1% year-over-year increase in revenue and an outstanding 40.8% surge in earnings per share. This success can be attributed to a combination of strong demand as well as strong margins. Despite this strong performance, markets were worried about Caterpillar's backlog. It ended the third quarter with a backlog of 28.1 billion, which fell by 1.9 billion compared to a year ago, and this could be a sign that demand for construction equipment worldwide could be stalling. Given that backlog is a function of demand and lead times, not all is bad news, as normalizing lead times likely drove order softness as dealers did not have to book in advance like they had to last year, given improving supply chain conditions. Despite this decline, Caterpillar's order backlogs still continue to remain at elevated levels compared to historical levels, and moreover, its sales to end users are still growing given the healthy end market demand. Moreover, when we look at Caterpillar, we find that non-residential construction demand continues to remain a bright spot, with public spending usually being less cyclical than private spending. We especially expect to see continued growth in this area, especially in North America, due to the impact of government-related infrastructure investments and a healthy pipeline of construction projects. Caterpillar is a major beneficiary of the substantial investments flowing into the infrastructure projects, particularly through the landmark 1.2 trillion Infrastructure Investment and Jobs Act that was passed in November 2021. Half of this amount will need to be spent over the next 5 years, meaning that a lot of projects need to be shovel-ready fast, and this would spur the additional demand for Caterpillar's products. Last but not least, investors can also find confidence in Caterpillar's status as a dividend aristocrat, which boasts an impressive track record of 30 consecutive years of dividend increases. Looking ahead, we project a target price of 288 by 2025 based on a fair price to earnings multiple of 15 times. And to get the full analysis, scan the QR code or click on the link in the description below. Next up, 𝗍𝗃 will be sharing more about 𝗪𝘆𝘀. Over to you, 𝗍𝗃.
Hello and a good day to all. I'm 𝗍𝗃, Research Analyst at Global Fixed Income. In the intricate landscape of corporate finance, 𝗪𝘀𝘀 has made significant strides in reducing its debt burden. However, a closer look reveals that the company still bears a notable level of leverage, prompting careful consideration in the investment realm. Despite generally poor performances across the past years, a silver lining remains in that significant cash flow continues to come in from the incremental completion of projects. This provides a much-needed reprieve for 𝗪𝘀𝘀 given the large amount of borrowings set to mature in 2023 itself. The forward-looking perspective of 𝗪𝘀𝘀's financial landscape presents an intriguing picture. The company anticipates a substantial cash inflow of SGD 737 million in total, with SGD 278 million stemming from its development projects in Singapore. This projection, rooted in future progress billings, outlines a roadmap for 𝗪𝘀𝘀's incoming liquidity. In addition to that, doubling up 𝗪𝘀𝘀's development project in the UK will be crucial to its performance in the near term. With a GDV of SGD 1.26 billion, this project will be 𝗪𝘀𝘀's opportunity to reverse the losses it had been seeing. Thankfully, the incoming cash flow from other projects should alleviate some of 𝗪𝘀𝘀's immediate worries, and this buy times for 𝗪𝘀𝘀 to see this particular project thrive. Despite 𝗪𝘀𝘀's position carrying a higher credit risk compared to its Singaporean high-yield counterparts, we would like to note that a default on 𝗪𝘀𝘀's 6.9% paper seems unlikely, given the incoming cash flow from the development projects. Existing bondholders therefore need not be overly worried, although it would still be wise to monitor the performance of this company. In the broader context of investment strategy, we maintain our advocacy for allocating resources towards quality issuers. The prevailing uncertainty in global economic growth underscores the importance of prudence in investment decisions. We prefer quality issuers that are less expected to see significant deterioration in their credit profile should there be a slowdown in growth. As we continue to expect interest rates to remain higher for longer, high-yield issuers are likely more impacted by the persistently high interest rates. To get the full analysis, scan the QR code or click on the link in the description below. That wraps up for the sharing of this week. Catch us again next week for more investment ideas and updates.